Hi, I'm David Harmon. I'm with my partner Keith Cook, and we're with RE/MAX in Whatcom County. And we're going to dive in a little bit on some financing options that might be, I guess, considered a little bit less traditional, maybe have stigmatisms or different things about them that people aren't aware of that actually are a great asset and a great tool to use. So we're talking about hard money loans and private money lenders. And I guess, yeah, what is a hard money loan?
Hard money can either be a private or institutional, and it's kind of easier just to talk private parties a little bit first. So hard money comes into play a lot of time. People need money in a hurry, and so usually a hard money loan is going to be an equity based loan. And so what you're not going to find, these aren't necessarily people who are going to go and privately. So there's two sections that will do hard money loans. There's some outfits, and their whole idea is to look for higher interest, higher yield loans, and they have people that will invest in these companies, and they're treated like a companies. And there's also private individuals that will lend money as well. So let's just start with this with a private individual to understand how that would work personally, and then see how that would work with a company. But personally, it would maybe, say if I've got a house worth 100,000 and I owe 50,000 and I need like 10 grand right away. I need it, multiply it by whatever you're looking at. I don't have the money and I need it like in a week or two. What am I going to do? So you'll find someone who'll say, all right, there's less risk for the person. So if I borrow 10 grand from you, you're going to be in a secondary position. So I have a first of 50,000. Your 10,000 is in secondary position, but you're relatively comfortable. It's like, yeah, if Keith doesn't make a few payments, Dave just bought a house for 60 grand because he could go through a foreclosure process and take that back. So that's basically a good number on how it is, and these are generating new loans on a equity based. And now usually if you need it quick, Dave, if it's a personal, he may not require an appraisal. He may just look at, do a drive-by and look at it and say, yeah, I'll lend you some money. It's not going to be a 30-year loan. It's going to probably be a 1 or 2 year loan. You're probably going to charge me, a lot of points. So in fees. So if say the rates right now are at 6%, you might charge me 12%. You might charge me, lend me 10,000. You might charge me 1,000 just to put the loan together. So as soon as you lend me the 10, I owe you 11. The way this would work is a company. Say Dave just said, I got 10 grand I want to lend out. I don't really want to go lend it to Keith or just deal with all the paperwork and stuff like that. There's some investment companies that you can go talk to and said, all right, you can buy a share. So let's just say I was borrowing $1 million, and they may put together a group of investors who would come up with $1 million, and they kind of broker it and oversee everything. But everyone is still getting that 10% interest, just on a smaller scale of what you're getting paid out on. They're going to have different requirements as far as what's their minimum investment and how much they're going to look into stuff. And it's a little bit more passive, but you're going to get a greater rate of return than you would normally in the bank. In some aspects, a private money loan, where we'll see those in probably most often in a transaction, is when we have a seller who owns a property. So Dave's got his property, he's worked hard, it's worth 100,000, and I want to buy it for 100,000. For a variety of reasons, Dave would like to sell it on a contract. So if, let's say he paid $10 for it when he was a kid, if I give him the 100,000, that's now going to be taxed. And so now his 100,000 is going to look more like 80,000 for when he's going to go reinvest it. If he doesn't really want to work too hard on it, maybe he puts it in the bank and gets a 1 or 2% interest. So he's going to get, say, 2% interest on 80 grand. So there's $1,600 a year that he's going to make. Now, if I'm going to buy the property and I owe you 100,000 and say I'm paying you 8% interest, now you're making 8% on the full 100,000. So you're going to make $8,000 a year, or $8,000 just in interest. And on that 20,000, you're getting 8%. So you're making 1,600 just on the extra. So you're making on what you would have paid tax the same amount on what you would have just made in the whole investment. So Dave's not greedy, but he likes money and sees the opportunities, because he may also realize maybe it's easier to sell it for 100,000. Maybe it was only worth 95,000. So he squeezed a little bit more on the price, and he likes the interest rate, and he likes the monthly payment. So that's traditionally where we will see private money loans in real estate transactions with a direct buyer and a direct seller. And usually there's a mutual benefit for both parties.
And I think for the most part, we see, especially like on the hard money stuff, is that these lenders they're actually investors. They're smart people. They know what they want. They're not seedy people. Generally, they are, especially the ones that we have dealt with and stuff. They enjoy real estate. They love investing in real estate because they see it as a really strong asset as opposed to maybe some stock market stuff. So they'd rather put their money. So if they can get, an 8% return on their money and their bank's only paying 3%, it just makes sense for them to loan some money out that they have extra to do with. And so it's actually a pretty solid thing if you get the right lender.
It's pretty safe, and versus you pick a stock and then you have to get up every morning to see what it's worth or isn't worth, or how much you lost on it. So it's fairly predictable. You're gonna know your rate of return all the way through it. The big risk is if you get the property back. And in Washington State, it's a non-judicial foreclosure state. So usually it's going to take, I would say right now, probably 9 months or so to start to finish, get the property back. So it is some work to get that back, and it can happen. So you're protected. It's not like a stock. You're going to go and sell the stock and lose all your money. So you will have that. And there's the incentive. If say you get foreclosed on, you get the property back, you could come out ahead, or else it's just you're cashed out right then at the foreclosure sale. Where hard money meets, kind of private parties, it's just like we were saying earlier, it's a matter of what the rate of return is and how it's positioned. So usually the seller of a property also has the incentive trying to work the sale. And so the important to them is they're trying to create a buzz or excitement, or what can they do to entice someone to buy that property, because that's their goal. So they're getting a couple of things here. One, they're selling the property, and two, they're taking care of how to worry about what to do or where to reinvest their money. If you're going to take a different scenario where you're just looking at an investor and they are not associated with the property, they're going to typically be looking for a greater rate of return because they're not calculating any rate of return on the actual real estate sale. So that's why they charge more. And they're not hundreds and thousands of these people. So usually they can charge a little bit more money, and what they're trying to do, it's a service. They're trying to be really quick and fast and, give you your money right away. You need money in a week or 2 weeks. It's, clearing title. A lot of the other stuff's the same with title and escrow, but it can happen pretty fast. The trick on this is a subordination, and that's a seller subordination. So say the same scenario, I want to buy Dave's property. And I said, well, listen, I'll give you 60,000 down and I'll owe you 40,000. Dave's like, yeah, that sounds good. I like 60 for whatever reason. But I would say, all right, my 60,000 down needs to be in the form of a first mortgage. So I want to put a first mortgage against the property. So you get the $60,000, but if I borrow the money from Kyle over here, Kyle has the first right to get paid back, and now your 40,000 has the second right to get paid back. These are where they get tricky, and these are, I would say, potentially dangerous for Dave, because if Kyle and I are in cahoots and all of a sudden I'm going to buy it and then I forget to pay Kyle and you, well, if Kyle forecloses, Kyle just got the property for 60 grand. Go through the foreclosure unless you want to step up and give the money back, or what do you want to do? So something to be, I guess, a little bit worried about that, but just to see how that would work. Some people with these late night TV shows, the guy with the boat and all the girls and stuff, that was kind of what they would do, some of the stuff with just how to find something and borrow the money down. Another aspect of this may be, let's just say, same scenario, but we were only going to give you 40,000 down, but it's a $60,000 mortgage. So with that coming down, Kyle gives me 60,000. I only give you 40,000. So I keep 20,000 myself. I like money too. So I keep the money, and that's a way to get cash up front on a sale, because Kyle's not worried. He's only got the the 60 grand into it, he's happy.
Right.
You get 40. In this case, you get an IOU for 60 as well. So you have an IOU for 60,000. Kyle, the camera guy's got one for 60,000, and I got 20,000 cash. So the incentive for me, I don't have any skin in the game, so it might be more likely that I might kind of get out of the deal or something like that. But so I just think a lot of in real estate, if you just got to know who you're working with. A situation like this, you may like it could potentially work as long as you know what you're working with. I would want to absolutely vet the borrower, see if the borrower has any additional collateral. So if I'm willing to do the same thing, I said, well, you get a second, but I'm also going to put my house up for collateral. All right, well, you're like now more protected because you're going to have the equity or the security in another house. So a second isn't terrible. It's just a matter of like, what is the collateral? Without that, your second would have gone up to 120% of value. So it was like, all right, you would have been at a higher risk. So Dave, if someone's out there and they like the idea of owner financing or contracts or doing some type of hard money loan, how do you think people locate these properties?
I think it's especially for us, we just like go over and explain to when we have sellers or we see different situations. We try to go over every scenario. And for some people selling on a contract, they didn't even think about it. But then when you explain it to them, maybe they meet with their accountant or whatever, then it actually is like, wow, that's actually the best option over anything because there's so many advantages. You're not paying capital gains, you're deferring that a little bit, but you're also making some interest off your loan. You're basically becoming the bank. So it's definitely a positive for a lot of people. And it's just a matter of them not being aware of it, or some savvy people are, and they'll come to brokers that are familiar with it and that deal with it on a regular basis. Because I would say, it's a small group of people that actually deal with a lot of owner finance in the real estate market.
We're not trying to make it seem shady. We think it makes sense. A lot of times if you are, say, the one going to lend the money, there's things that you would want to look at, like, the buyer's credit, their financial statement, have your attorney review it, have your accountant look at it. So, look at the title report, make sure you have a title policy, take a look at the property.
Right.
You're going to look at someone's credit report history. So you're going to have a lot of information on the property. And so it does make sense. But when we're out there, if we meet with someone who wants to sell a property, almost any property, residential, commercial, multifamily, we always try to at least look into what are their financing or what are their exit options, because traditionally we found that we can sell properties a little bit above market value if we're creative with financing. And so the reason people may want this is a variety of reasons, but it makes it a lot easier to get a loan and close right away if you don't have to go through all of the kind of the lender bureaucracy of appraisals and the 15 people checking you out at the bank. So, and that works too, but this situation, you're dealing a lot of times with a seller, whether it's one or two sellers, so and they're one attorney and an accountant, so it's not like a committee. It's like, all right, if it makes sense, it's pretty easy to do.
Yeah, I mean the history of home and land sales, that's how all it was. There was no banks involved. You couldn't go to the bank and borrow money to buy a house. You were buying it from the landowner or the individual that actually owned it, and you typically are paying them for the money. If you didn't have cash, then you do seller financing,
right?
And
it's a little more old school way of doing it, just with taxes. And I know people like our dad's ages were kind of more the wheeler dealers back then, and I know my dad had traded apartment buildings, and there weren't due on sale clauses, which you had to pay the mortgage off, and so there was a lot of types of really crazy ways to get stuff. It's interesting how you can just try to get creative. And if there's a will, there's a way. And the one item that has to not necessarily happen the most, but it definitely helps if people are dealing with equity. So the seller, if you have a 90% loan on your property of the value, you're not going to be able to sell under contract because it all goes to the bank. Right. So they're usually reserved for people who have the property free and clear or close enough to being free and clear. So if I owe 20% left on my balance of the property, it's like, I can't do owner contract. Well, if Dave comes in with 40% down, then he pays the loan off and we're good to go. So it's a great tool to have, I think, for people looking in there. I think it's great for investors to know if you can find a property and know that you can buy it. I've sold a lot of properties cash down, cash back, no money down, all that late night TV stuff. And that's a lot of work, and it's a grind to go find those properties, because usually what you're looking for are distressed property situations, or just someone needs to get it sold right away. But the key ingredient for all of these sales to come together is equity, or an implied value, or something that someone can do to force value, that a seller's letting something go a little bit on the less expensive side, or their crazy terms. So it's welcome to our world. This is the fun part, getting in the trenches and trying to see what we can do with these, and locating properties that may work for you. And I guess it's presenting it in the right way that might work for the seller. Even though the seller may have met with their broker and didn't think of all these ideas, if you give them a nice offer and it looks good, and it's really how to present it. So,
well, thanks for watching. I hope you got some info out of this. Hard money and private lending is definitely kind of a tricky situation, and it's an individual case by case where it could be a good thing, it might not be a good thing. So there's a lot to actually dive into that. We'd be happy to sit down with you or have a conversation and get a little bit more in detail on it. If you're an investor, we can put you in that avenue as well. But yeah, definitely make sure you like and subscribe and send some good comments. Thanks.
Thank you.